What do you think of foreign currencies? And by foreign currencies, I mean not the US dollar. Sterling, the euro. I mean, the euro could easily capitulate here in this environment.
Oh, I'm extremely bullish on the dollar. In fact, I did a media tour in November and December, and even as far back as August, I was saying we're coming into a major, major bottom in the dollar. The daily sentiment index was down at 3% bulls, which is very, very low in the dollar index, for several times during the fall. It was a terrific setup. People were going around making speeches about hyperinflation. Meanwhile, silver refused to confirm every single high that gold was making in 2009. So you had a perfect setup for a major turn in the dollar, and I think we got it. And I think it's going to go far higher than most people believe. The bets against the dollar seem to be across the board from all kinds of commentators, advisors, and so on, and I think those people will end up covering before this rally is over.
Do you like sterling?
Not particularly, because I think the dollar is the currency in which the bulk of the world's debts are denominated. It's a bigger ocean of IOUs than we have in sterling or in euro or in yen. So that is the currency that has the greatest capacity for deflation, and that's why it's going up. It's not going up because of good news, it's been going up because of bad news. So I think relative to the dollar, virtually every other currency will be heading lower.
What about the commodity currencies, the Canadian dollar, the Australian dollar?
I pretty much feel the same way about them. Their economies are not as debt-laden as the U.S. economy or Europe for the most part. So they have less deflation to go, and that means their currencies should not be as strong as the currencies that are going to be imploding, oddly enough, at least the major currencies that are going to be imploding. So they've had terrific runs. I mean, it was a great time to be in those currencies for the last year, but that game is over. I think the trend has changed. We'll see what happens.
So it's basically, I mean, there is a definite trend that's been in place. It's the US dollar and everything else.
Exactly.
And at the moment you're saying, forget everything else, go
right.
for the US dollar.
Now this is very interesting because you had mentioned the coupling before. When the stock market bottomed in March 6th and 9th of 2009, that is when the dollar started getting weak. So you had a perfect counter-trend move, and at the time we said, look, we've just made a beautiful bottom. It's a terrific 5 waves down in Elliott terms. We got as low as 2% bulls on the daily sentiment index. S&P had never been that low ever. That means 98% of traders thought the market would go down instead of up. So that was a terrific juncture. So what can you forecast as a socionomist when you see that? We're going to have more optimism for a while, a number of months, and we felt that a normal retracement would take the Dow back to 10,000. We were saying that back in March. So what goes along with increased optimism? For one thing, spreads come in on bonds. So you have the junk bonds rates coming closer to the safer or perceived safer bonds, and people generally feeling better. You get the economy improving near the end of one of those trends. We've already had 2 big up quarters in the economy, at least statistically in the United States. And so we've had all of the things happen that we expected to happen, and during that time the dollar was weak. Now I think we are beginning a new trend that should last a year and a half, 2 years at least, of increasing pessimism. So you're going to get the opposite. You're going to get spreads widening again, you get stocks falling in price, and you're going to have another contraction in the economy worldwide.
2 questions for you. Let's start with gold. I've heard people say that you've said, I've never heard you say this, but I've heard people say that you've said you've got a target of $200 for gold. Is that correct?
I think I think gold is going to go down a lot more than people suspect. It's the only market that everyone loved in 2009, the only one. And it's the only one that went to a new all-time high. All the other commodities lagged, and even its partner silver couldn't get above the 2008 high. So that is where the focus was. Any market that's got an overly strong focus, such as tech stocks in March of 2000, and you saw what happened to the NASDAQ after that, relative to the Dow and the other indexes. The focus here is on gold. I think that makes it extremely vulnerable. It went up for 10 whole years. And there was a great article in Barron's in February 2001 about gold, and every single person, whether he was a trader or an industry person or a commentator, was negative on the price. And they said, we see absolutely no reasons for gold to go up. At least 2 people were quoted as saying that. Today, there are commercials for gold on late-night television. There are vending machines where you can buy it, and everyone loves the market. This is not a good time to be invested. And when it becomes time, we'll see all the indicators change again. People will think gold can't go up anymore, and we'll be bullish.
What happened in 2008 when we had mass deleveraging? What happened in the gold market was there was a divergence. There was mass selling in the paper gold markets, in the futures of gold stocks and so on. But there was so much stress in the banking system and there was so much panic that a lot of individuals were going to bullion dealers and buying bars of gold and buying Krugerrands and buying sovereigns and all the rest of it. So there was this contradiction, and the gold dealers who I talked to here in the UK reported unprecedented levels of business. There's an essential contradiction there, because there was a rush to the real safety that is gold, but in the kind of paper derivatives there was a rush away from it because the derivative market is credit based. If we I see gold as a hedge against stress in the banking system. That's when gold seems to do best. People say gold is a hedge against inflation. It isn't. The 80s and 90s were a period essentially of inflation, of asset, of credit, of everything else, and gold went down for 20 years. So it's a hedge against stress in the banking system. So if we see your scenario of deleveraging pan out over the next 2 to 5 years, it's possible that we'll see that contradiction where people are buying physical gold, but we still have the selling in the paper markets.
I don't agree with that. First of all, 2008 gold did go down. It went down from March to October and lost about 30% of its
absolutely.
value. And silver went from 21 to 8.
Absolutely. I'm not talking about silver, because silver is an irrational metal.
Okay, but people only talk about gold now because it's the one market at a new high. So, of course, everything else doesn't matter, but it does matter.
Okay, but I agree that silver kind of informs you about gold.
Platinum.
Well, platinum's different because it's an industrial metal. It's not a monetary metal.
I think silver is too.
Okay, but that's a discussion for another day. But the point I'm making about gold is that people were buying in the physical market, but they were selling in the paper market.
Well, they were actually selling because the price went down during the worst portion of the deleveraging and the deflationary run in 2008. Gold went down. Now, as the system began to reflate, gold had another leg up. It's been basically going up and down with the stock market. It went up throughout the entire time that stocks went up. From 2002 to 2007, gold was going up, and it was having a heyday. And the only time it really had a strong hiccup on the downside was that deflationary period in 08. And now, look what's happened. Just days after the U.S. dollar bottomed, gold seems to have topped at 12.27. That was just a few days from the dollar's bottom. Now, I would say fundamentally I disagree that gold is a hedge against difficult times or banking stresses. It's over a long run, it's a good reflection of inflation. But most deflationists want to have it both ways. They want to say gold can go up during inflation, and with deflation it's a hedge, so you want to own it. I don't think that argument works. If you believe one side of it, you have to say the other side is the contrary side, and gold should go down during inflation. I believe I'm being consistent in saying that's likely to happen.